So this morning, the report card on the health of the U.S. economy was released, and it missed consensus. But, there was a time in last year when you would have thought 4% fourth quarter GDP growth would be impossible. Now, that said, I did see some good stuff in the report, especially gross domestic investment. That was positive. But personal consumption stumbled big time, just 2.5%, down from 41% growth in the prior quarter. Now, the report only adds intrigue to the next move from the Federal Reserve. So what is the true state of the U.S. economy, and really what must be done at this point to bring it back to 100% health? Let's ask former chief economist at JPMorgan Chase, Anthony Chan, along with First Trust Advisors chief economist Brian Wesbury. Two of the best. Brian, let me start with you. Just your assessment of the GDP report and where we are in this economy right now.
Yeah, Charles, if you we think about 2020, the first stimulus was winding down when we went into the fourth quarter. Then we started new shutdowns, and then we didn't pass the second stimulus until late. And what got caught in the middle was that fourth quarter GDP number. I'm really interested about what happens from here, and it looks like the first quarter, it starts out pretty low because of that weaker fourth quarter. But then I think we start picking up in the second half of the year. We have headwinds. There's tax hikes coming. There's regulatory increases, got more government spending and a bigger government. But nonetheless, I think we're going to power through that and have a pretty good 2021.
Anthony, a lot of folks on Wall Street modeled for at least the first half of this year, perhaps the entire year, to be carried by more Federal Reserve accommodation and a huge fiscal package out of D.C. Maybe two, right? The 1.9 rescue package and then an infrastructure package after that. How critical is it that we get those things, or to Brian's point, we continue to slump?
Well, I think that if we get those things, Charles, that you mentioned, we can see that real GDP growth will come in close to 5.8%. And you're correct and spot on that 4% growth is respectable. But when you had the first quarter last year contracting by 5%, and the second quarter contracting by 31.4%. That means that despite the strong growth that we saw in the third and even the fourth calendar quarter, we still have the level of GDP coming in much lower, close to 2.5% below where it was in the fourth quarter last year. And for the year, on a year-over-year basis, real GDP is still down 3.5%. That is why the Federal Reserve is determined to continue to add $120 billion worth of liquidity every month at an annualized pace, about $1.4 trillion. And of course, those two stimulus packages that you've mentioned.
So, what's interesting about that is equity futures actually turned higher on this GDP miss, which of course suggests that Wall Street could expect even more accommodation, not just this fiscal stuff, but from the Fed. And on that note, Brian, Wall Street didn't seem too enthusiastic yesterday when the Fed said, yeah, we're going to keep that $120 billion coming. They yawned. The market sold off. Could the Fed actually do even more at this point?
Yeah, Charles, I mean, I hear you, and it could be for all those reasons. I kind of look at yesterday and today. We have all this stuff going on with GameStop and, these other things that are in Robinhood, closing down, all of this stuff going on. I think there's just been a lot of confusion in the market. We have so much liquidity, as Anthony said, the $120 billion a month. And one thing I do want to point out, I'm going to point out both sides here. Even GDP was down last year from the year before, even after that huge recovery in the second half. But if we take out the government spending, remember, we're giving people cash, we're giving people loans. If you take all of that out, the economy today is about 10% smaller than it was. And that reflects really bad damage to small business in the United States. This government spending, it's the credit card from the future. It has to be repaid. It's fake growth. And so we need to open up and get these small businesses coming back. The Fed can't print our way to wealth.
Yeah.
We just have to reopen our way to wealth.
To that point, I think everyone agrees. If you keep us locked down, we're going to need another package in 3 months and another package after that. I got 30 seconds, but Anthony, let me get your thoughts because Brian just brought up, the whole saga with the GameStop and the short squeezes. And a whole lot of folks are sort of, in my mind, punting instead of, saying, hey, Wall Street is circling the wagons around these hedge funds. The easiest entity to blame has been the Federal Reserve. The Federal Reserve and all of this money printing, does it really get to the retail person in the sense that they can go out there and buy $20 billion worth of GameStop in a single session?
Well, we know that all that liquidity has, in fact, boosted the equity market. Last year, we had more than 16% growth in the S&P 500. And by the way, all those stimulus payments with people staying at home, you've seen that the savings rate has picked up, and a lot of that liquidity has gone into the equity market. So it's not just the Federal Reserve, it's the federal government also that has contributed to this excitement in the equity market.
Anthony, Brian, thank you both very much, gentlemen. I appreciate it.